Did you know that Warren Buffett, one of the world's top investors, views idle money in the bank as a financial trap? In times of high inflation and uncertain economies, letting your money sit idle is practically watching it lose value daily. In this video, I'll reveal 14 powerful assets that Buffett and other experts consider essential for protecting and growing your capital, even in times of crisis. At the end, I'll share an exclusive recommendation for those who want to know how to allocate amounts from $10,000 to $300,000 to get the most out of these assets. Let's start with the first. Short-term fixed income funds, a solid choice for those seeking security with consistent returns. These funds are ideal for conservative investors who prefer a safe harbor over market fluctuations. Since they invest in shorter-term bonds, they are less affected by interest rate changes, making returns more predictable and stable. Perfect for those wanting a steady investment that aligns with economic trends without major shocks. And of course, it's a far better option than leaving your money idle. With high interest rates in 2024, short-term funds have gained prominence for offering returns that match the current scenario. Funds like the iShares Short-Term Corporate Bond ETF, IGSB, which focus on high-quality corporate bonds, provide solid returns without exposing investors to significant price fluctuations. This low volatility attracts many conservative investors, especially in uncertain economic times. Investing in short-term bonds is like securing your reservation at a restaurant when you're still deciding what to order. You have your spot, a quick return, and the flexibility to change your investment order if the market shifts, all without committing to the long term. In summary, short-term fixed income funds offer security and consistent returns without the prolonged exposure of traditional bonds, a great option for starting a portfolio with a secure and profitable asset. Now let's talk about one of the oldest and most solid assets to protect your money in times of crisis: precious metals like gold and silver. Gold is considered a universal store of value. In times of crisis, it's a real vault. Imagine that feeling of keeping something valuable at home. You put it in a drawer, check that it's locked, and even place a shoebox on top just to be sure. Gold functions this way in the financial market. It's the treasure everyone wants to protect. Currently, it's priced around $2,744 per ounce, with a recent slight correction of negative 1.57%. But it saw a significant increase of 38.38% over the past year. This notable performance makes it one of the most sought-after assets when the economic outlook isn't too favorable. With the high US debt and elevated interest rates, gold continues to be positioned as a safe asset to protect your purchasing power, especially in times of crisis and recession. Silver, too, doesn't fall behind. Priced at approximately $32.61 per ounce, it saw a recent drop of negative 3.39%, yet it maintains a positive trajectory in the medium and long term. Besides serving as a store of value, it's widely used in industry, which helps sustain its demand and value. Analysts believe that with a possible recovery in the industrial sector, silver's value may continue to rise. While bank money loses value, gold and silver remain valuable assets that protect purchasing power in times of crisis. But how can you invest in these metals? There are several options. The most direct way is through physical purchases, acquiring bars or coins from reputable suppliers. If you prefer something more practical, you can opt for ETFs like SPDR Gold Shares GLD for gold and iShares Silver Trust SLV for silver, which provide exposure to these metals without the need to store them. Another alternative is investing in mining stocks, like companies that extract gold and silver, offering indirect exposure and growth potential. In summary, gold and silver are excellent financial shields. Gold, with its history of protection against financial crises, is ideal for long-term security, while silver, with its industrial application, offers a mixed profile of safe investment and growth potential. The next and third strategic asset worth considering is essential commodities like oil, natural gas, and agricultural products. Commodities are indispensable because demand for them is constant. Remember the shock of going to the grocery store and seeing prices for everything rise? Commodities follow this same trend. The difference is that while we lament the price of basic goods, investors see opportunity in essential products that retain value. Speaking of which, oil is priced around $70.51 per barrel, with a recent increase of 2.77%. This recovery reflects the constant demand, combined with some challenges in global supply. Brent, another important reference, is at $73.17. Oil is a commodity that tends to be sensitive to geopolitical issues and energy transition policies, but its relevance doesn't diminish. It's crucial during times of uncertainty. Moving on to natural gas, it is currently around $2.70, but with a decline of approximately negative 5.1%, reflecting its high short-term volatility. Natural gas is essential for energy generation, especially in regions that still rely heavily on fossil sources. Despite fluctuations, it remains a staple resource in times of high demand. Agricultural products like wheat, soy, and corn also play an important role. Wheat is priced around $572, soybeans at $996.5, and corn at $411.25, all with slight variations but maintaining stability. The constant demand for these food and agricultural products makes them less volatile and safer, even in supply crises. Leaving money idle in the bank is risky, but as you've seen, investing in commodities like oil and agricultural products offers solid, resilient protection. How to invest in these commodities? There are ETFs that make exposure to these commodities easier, like the United States Oil Fund, USO, for oil, and the Invesco DB Agriculture Fund, DBA, for agricultural products. For more experienced investors, there is also the option of trading futures contracts, a more complex approach, but one that allows direct gains with commodity price fluctuations. These essential commodities offer strong protection during uncertain times. While oil and natural gas can be more volatile and sensitive to geopolitical changes, agricultural products like wheat and soybeans are more stable choices, ensuring resilience for your portfolio. Now let's talk about an investment everyone has heard of. Real estate investment trusts, or REIT, are fourth asset, which essentially are funds that invest in commercial, residential, and industrial real estate. If you've ever considered earning extra income from real estate without the hassle of managing rentals, these funds can be an excellent choice. They not only allow you to invest in large-scale properties, but also offer liquidity and pay part of the profits in dividends, providing a stability that the traditional rental market doesn't always guarantee. In 2024, REITs have shown strong performance, outperforming the general market with significant capital raising, reaching over $23.3 billion in secondary offerings and IPOs in the third quarter. This indicates investor confidence in these long-term funds. Additionally, U.S. real estate funds have a significant economic impact, supporting around 3.5 million jobs, reinforcing their relevance as a safe and resilient choice. Rather than watching your money lose value, these funds allow you to invest in real estate and generate passive income without complications. But how to invest in real estate funds without getting into the complex game of buying and selling properties? You can start with REIT ETFs like the Vanguard Real Estate ETF, VNQ, which offers broad exposure to the US real estate market. Another option is to invest directly in REITs in specific sectors like healthcare, logistics, and infrastructure, which tend to be less volatile and less susceptible to market highs and lows. And let's be honest, everyone has that horror story about renting, right? Think of that friend who waited forever for a plumber who never came, or had to change the lock after an accident the tenant couldn't quite explain. With REITs, you escape that headache. No maintenance routine or dealing with complicated tenants. You just invest and receive the income, which can even be monthly. In summary, real estate funds offer a way to invest in real estate without the drama of rentals, with liquidity and stable dividends. Now let's talk about our fifth asset, government bonds, or the famous bonds issued by the US government. If you've ever thought about investing in something guaranteed, but without the risk of a big adventure, these bonds are a safe and classic choice. Practically, it's like lending money to the government in exchange for an interest payment. And let's face it, who doesn't want a safe return guaranteed by Uncle Sam? There are different types of government bonds, but the two most popular for protecting purchasing power are Treasury bonds and Treasury inflation-protected securities, Type ES. In 2024, Treasury bonds are on the rise due to high interest rates, which offer better than usual returns. For example, TPS adjusts the principal according to inflation, so while everything gets more expensive at the grocery store, your bond is there, maintaining its value, and even growing a bit with inflation. Treasury bonds are attractive to conservative investors because they provide stable and consistent returns. As US inflation and monetary policy continue to be monitored, these bonds remain a solid choice. And with the rise in interest rates, government bond yields are quite appealing to those seeking stability. Now, if you've never considered investing in bonds, it's like lending money to a very reliable friend, the one you know will pay you back if they owe you money. It's low stress. Except, in the case of government bonds, that friend is the US government, which is practically the friend who never bails. If you want to invest, you can do it directly through Treasury Direct or opt for bond ETFs like the iShares US Treasury Bond ETF, GOVT, which already offers a basket of bonds for diversification. In summary, government bonds are a way to earn returns safely, without the drama of market fluctuations and with the comfort of knowing your loan is in good hands. Now we come to the sixth asset, a type of investment that combines security with a revenue stream, dividend stocks. Imagine receiving part of the profits from large companies regularly without having to worry about stock ups and downs. That's exactly what dividend stocks offer, a source of predictable passive income, ideal for those who prefer an investment that doesn't depend heavily on market fluctuations. Companies that pay dividends regularly are generally large and well-established. In 2024, stocks in sectors like finance, healthcare, and consumer goods are among the most resilient. Companies like Kraft Heinz, offering a yield of 4.74%, and One Main Holdings, with a yield of 8.34%, have attracted investors looking for a stable income source. Another standout is Enbridge Inc., with returns of up to 8.19% in some share classes. These companies tend to be less volatile and have a good history of profit distribution. How to invest in these stocks? You can buy shares directly from large dividend-paying companies like Procter & Gamble or Johnson & Johnson, which have a solid payment history. Another option is to invest in dividend ETFs, like the Vanguard Dividend Appreciation ETF, VIG, and the iShares Select Dividend ETF, DVY, which offer a selection of high-yielding company stocks. Now, if you're thinking that investing in dividend stocks is like getting a monthly allowance from companies, you're not too far off. It's like that rich uncle who sends you a little extra each month. Only in this case, The uncle is a giant stable company and the allowance comes in dividends. Best of all, no need to call and say thanks. In summary, dividend stocks are a safe way to earn extra income, providing stability and reducing the impact of possible price fluctuations on stocks. Now let's talk about a type of investment that offers automatic diversification and risk reduction: index funds, like the popular S&P 500. The seventh asset on the list functions as a bundle of stocks, allowing you to invest in hundreds of the largest companies on the market at once. It's a smart way to protect yourself from the volatility of individual stocks, since your bet is on the overall market performance, a strategic choice for those seeking safe growth. In 2024, ETFs that replicate the S&P 500, like the SPDR S&P 500 ETF SPY and the Vanguard S&P 500 ETF VOOO, remain among the most popular. Despite some market fluctuations, they continue to be options for relative stability and consistent returns. Also, index funds have low maintenance fees, making them an attractive alternative for those seeking returns without much hassle. These ETFs are so broad that it's like entering a VIP party of the economy, where the largest US companies are gathered. Instead of guessing which company will grow the most, you put a bit in each one. It's like betting on all the best guests. And of course, if one company isn't doing well, others compensate, keeping your investment in the green. Now, if you're the type who hates choosing which stock to buy, index funds are perfect. It's like ordering a combo at a restaurant because you don't want to choose just one dish. Here, you get a bit of everything, with the benefit of diversifying your portfolio without complication. To get started, just buy index ETFs at any brokerage, taking advantage of this safe and convenient strategy. In summary, index funds offer a simple and diversified way to invest, ideal for those seeking long-term stability and growth without the stress of monitoring each company individually. Now let's talk about high-quality corporate bonds, the eighth on the list, also known as investment-grade corporate bonds. These bonds are issued by companies with high credit ratings, from AAA to BBB, offering a higher yield than government bonds, but with controlled risk. It's the ideal balance between security and return for those seeking an interesting yield without giving up stability. In 2024, these bonds have attracted many investors, especially because of higher interest rates. As a result, yields have risen, making them more attractive. And because the companies issuing these bonds have solid finances, the default risk is low. They also provide a predictable source of income, attracting those who want to avoid stock market volatility. How to invest? A practical way is to buy corporate bond ETFs, like the iShares iBoxx Dollar Investment Grade Corporate Bond ETF, LQD, which offers a broad selection of high-quality corporate bonds. Another alternative is to buy bonds from specific companies through brokers, great for those who want to choose solid companies individually. If investing in corporate bonds seems a bit too serious, think of it as lending money to that reliable friend who never defaults. It's almost like lending money to a super responsible friend, the one with an expense spreadsheet. Except here, the company pays you interest, and on a set date. So, if the market fluctuates, there's no worry. You keep your predictable return without the typical twists of the stock market. In summary, high-quality corporate bonds are a stable choice for those wanting extra income without the stress of market fluctuations, with a more interesting return than government bonds. We've reached the ninth asset. Before continuing, let me ask you, are you enjoying the content so far? Then give it a like and leave a comment saying, I want more content like this, so I'll know you enjoy this type of video. Now let's talk about municipal bonds, issued by local governments to fund public projects. Essentially, it's like investing in public works like schools, roads, and hospitals. with the bonus of stable returns and federal tax exemption on profits. Yes, less tax. It's an attractive investment for those wanting a safe alternative with a social impact. In 2024, these bonds remain a solid choice. Despite some price fluctuations due to rising interest rates, many states are in good financial health, reinforcing confidence in these investments. Additionally, the increase in interest rates has raised the yields on these bonds, attracting investors seeking predictable, tax-free income. To invest, you can buy directly from local governments through brokerages like Fidelity or Vanguard, or choose municipal bond ETFs like the iShares National Muni Bond ETF, MUB, which offers a diversified basket of bonds. Now, if investing in municipal bonds sounds very serious, think of all those public works you've seen, like that construction that seems never to end. Well, by investing in municipal bonds, it's like helping finance these projects, except with the guarantee that they'll pay you back, and with a bonus of tax exemption. So while the construction might take time, your return is guaranteed and arrives on time, without the usual surprises of the market. In summary, municipal bonds are a safe and tax-advantaged way to earn returns, allowing you to contribute to local development while keeping your investment protected. Now let's talk about a type of investment nearly everyone knows: certificates of deposit, CDs, and high-yield savings accounts. These bank products are ideal for those seeking total security, since they are insured by the FDIC in the US, which minimizes any risk of loss. It's a practical way to guarantee a fixed return until maturity, especially interesting for those who prefer not to risk the stock market or more volatile assets. CDs have gained prominence in 2024, with yields that can exceed 5% per year, depending on the term and institution. With high interest rates, banks and credit unions offer attractive short and long-term CDs. High-yield savings accounts are also competitive, with some offering up to 4 to 5% per year, all with the liquidity of a regular savings account, meaning you can access your money anytime. To invest, you can buy CDs at institutions like Chase, Bank of America, and Capital One, or open a high-yield savings account at digital banks like Ali Bank and Discover, which offer competitive rates and flexibility. Now, investing in CDs is almost like putting money in a piggy bank, except this piggy bank grows on its own. Remember that piggy bank we had as kids? Only now it comes with interest. The difference is that instead of coins, you get your money back with returns, safe and secure. So, for those who want to stash their capital with a guarantee, CDs and high-yield savings accounts are options that combine simplicity and return. In summary, CDs and high-yield savings accounts are a stable, safe way to guarantee passive income, ideal for those looking to preserve capital with the peace of mind that it's protected and earning. Now onto the 11th asset, global bond funds, which invest in debt securities from different countries and currencies, offering geographical and currency diversification that helps dilute the specific risks of a single economy. In times of global economic uncertainty, this type of fund is a great way to balance the portfolio and gain exposure to different markets. In 2024, global bond funds have become increasingly attractive due to rising interest rates in various regions, which has raised the returns on these bonds. Additionally, these funds benefit from strong currencies and developed markets, with some even cautiously exploring emerging markets. However, it's worth remembering that besides yields, these funds also carry currency and credit risks. To invest in global bond funds, a good option is the Vanguard Total International Bond ETF BNDX, which provides diversified exposure to high-quality international bonds. This type of ETF allows you to benefit from diversification without needing to buy bonds from each country individually. If the concept of global funds seems complex, think of it as an economic suitcase for your international vacations. Instead of carrying only one currency, you bring a little of each, protecting yourself from exchange rate unpredictability. If one market isn't doing well, another can balance things out. After all, it's always good to have a plan B for vacations and investments. In summary, global bond funds are an efficient way to protect capital, offering security and diversification in uncertain economic times, with the possibility of stable returns. The next asset we'll discuss is a solid type of investment closely aligned with economic development. Infrastructure funds. These funds invest in infrastructure assets like roads, energy and transportation, sectors that tend to perform steadily even in tough times. After all, everyone needs electricity, water and transportation, so investing in infrastructure is like betting on an economic foundation that hardly loses value. In 2024, infrastructure funds have shown positive results, especially those focused on sustainable projects. The Global ex-US Infrastructure Development ETF, PAVE, for example, invests in companies benefiting from US infrastructure modernization initiatives, with a strong push from government policies promoting green energy and transportation. These funds are popular because they offer predictable cash flow, less susceptible to financial market fluctuations. Now, if investing in infrastructure still seems a bit abstract, imagine investing in paving the road you take every day. But in this case, instead of waiting for the government to act, you're profiting from the demand for services. It's almost like receiving a financial toll, except the investment is global and without traffic jams. In summary, infrastructure funds are a safe choice for investors looking for a combination of growth and stability, benefiting from long-term projects with an increasing focus on sustainability. Moving on to the penultimate asset, safe haven currencies, the US dollar USD, Swiss franc CHF, and Japanese yen JPY. These currencies not only retain value during crises, but also tend to appreciate. Their security comes from stable economies and strict financial policies, making them a safe harbor when the market becomes unstable. To understand the current scenario, let's look at each. The US dollar remains robust in 2024, bolstered by Federal Reserve policies. The dollar index, DXY, is near an important resistance at 103.8, indicating the currency remains strong, but also suggesting a possible correction soon. In times of economic uncertainty, the dollar shines as one of the most reliable currencies, attracting global investors. The Swiss franc is also a bastion of stability. Supported by a conservative economy and Switzerland's neutral policies, the franc has recently appreciated. The current USD to CHF exchange rate is around 0.86, showing resilience against the dollar and reinforcing its role as a solid option amid instability. Meanwhile, the Japanese yen is slightly more depreciated, pressured by the Bank of Japan's low-interest policies. However, with the USD/JPY rate high at approximately 152, the yen still offers stability, especially for Asian investors seeking a regional haven. A moderate recovery is expected if the Bank of Japan adjusts its policy. These currencies act as protection during crises, supported by strong economies and strict financial policies. Investing in the dollar, Swiss franc and yen is like the old habit of hiding money under the mattress, but a bit more modern. Instead of the mattress, you put it in the financial market. And yes, you can trust these countries to have more comfortable and secure economic cushions than ours. How can you invest in these currencies? The most direct way is to buy foreign currency through online exchange platforms. Alternatively, You can choose ETFs like the Invesco DB US Dollar Index Bullish Fund (UUP) for the US dollar, or use multi-currency accounts offered by brokers, which make storing and managing these assets easier. In summary, safe haven currencies are a smart protection in times of crisis. With the dollar and Swiss franc showing strength and the yen still a defensive alternative, these assets provide a financial shield against volatility and loss of purchasing power. Finally, let's talk about defensive equity funds. These funds invest in companies in essential sectors like healthcare, consumer goods, and utilities. The idea is simple. In times of recession or economic uncertainty, demand for essential products and services tends to remain stable. That is, while other sectors may suffer from market fluctuations, defensive stocks hold their ground. In 2024, defensive equity funds have attracted many investors concerned about a potential economic slowdown. Funds like the Consumer Staples Select Sector SPDR Fund XLP, which invests in consumer staples companies, have shown good performance with less volatility. These essential sectors continue to generate demand, even in tough times, offering a good alternative for those looking to reduce the risk of their investments. Now, investing in defensive stocks is a bit like that monthly shopping list we make. Even if the budget is tight, we always end up buying basics like rice, beans, and toothpaste. These essential goods companies are the ones that keep revenue stable regardless of the scenario. With defensive equity funds, it's like betting on these market essentials, ensuring some security for the portfolio. In summary, defensive equity funds are an excellent option for those seeking a more crisis-resistant investment, much better than leaving it idle in the bank, with stability and the peace of mind of a less volatile income flow. Now that we've covered the best assets to protect and grow your money, let's see how to apply them based on the available amount. After all, each amount deserves a personalized strategy, whether for $10,000, $100,000, or even $300,000. Today, leaving money idle can be a missed opportunity, and with inflation, this pause in investment could end up costing dearly. So let's go over some smart suggestions to make your money grow more than savings, and at the same time, protect your capital from the crisis. If you're starting with $10,000, the key word here is security with liquidity. Short-term CDs and high-yield savings accounts are ideal options. They are simple, accessible products, and the interest rates in 2024 are yielding between 4 to 5% annually, which is already a good advantage over regular savings. For those who want a bit more adventure, there are short-term fixed income funds. With low volatility and stable returns, these funds provide extra security without compromising growth. Suggested allocation: all funds in CDs or high-yield accounts ensure liquidity and security for a safe return above average. For $100,000, the idea is to balance security and returns. At this amount, we can pursue growth without neglecting risk protection. A mix that includes index funds like the S&P 500 can be great for diversification and gaining market exposure. Adding municipal or short-term government bonds offers safety and stable income, especially municipal bonds that provide tax-free income on returns. To finish with a touch of resilience, an investment in defensive equity funds provides stability in essential sectors, ensuring protection against crises. Suggested allocation: 30 to 40% in index funds, 20 to 30% in municipal or government bonds, 10 to 20% in defensive stocks, and a final touch with 10% in short-term CDs for that extra yield. For higher amounts like $300,000, the goal is maximum diversification with security and passive income potential. A significant portion can go to infrastructure and REIT funds. which provides stability and passive cash flow, especially in tangible assets like real estate. Adding global bond funds brings security and currency exposure to diversify the portfolio further. For growth, index funds remain a solid choice, and a touch of precious metals like gold and silver adds protection against inflation and instability. Suggested allocation: 30 to 40% in infrastructure and REITs, 20 to 30% in global bonds, 20 to 30% in index funds, and 5 to 10% in precious metals. These strategic allocations are like a recipe that mixes security, growth, and liquidity, so each amount works for you, regardless of the economic scenario. And remember, reviewing the portfolio regularly is always important, since the market isn't exactly known for standing still. As we've seen, there are safe and intelligent alternatives to avoid the trap of idle money in the bank. By choosing wisely, you protect and grow your wealth, even in uncertain times. Now you have 14 investment options in hand that offer a balance between security, liquidity, and earning potential. A powerful combination to build a solid portfolio capable of facing any economic scenario. If you enjoyed this content and want more practical tips and strategies to protect your wealth, leave a comment asking for part 2. That way, we'll bring even more insights and valuable recommendations for those looking to explore new financial growth opportunities.